Assalamualaikum and good day everyone. Today I will explain the objective of financial reporting, which is an important foundation in accounting. The main objective of financial reporting is to provide useful information for decision making. This means that financial reports should give information that is both relevant and reliable to users such as investors, lenders, and other creditors. With this information, they can make better decisions about whether to invest, lend money, or provide resources to the business. Next, financial reporting also help users access the entity's economic performance and financial position. This include understanding the company's asset, liabilities, financial performance, and cash flows. By having access to these details, user can evaluate how well the business is performing and whether it can generate future cash flows. In other words, they can judge if the business is financially healthy and sustainable. To summarize, financial reporting aims to deliver useful, accurate, and complete information so that users can make informed decisions and understand the company's true financial condition.
Assalamualaikum warahmatullahi taala wabarakatuh. My name is Haikal bin Muhammad Adam atau Zawawi. Today, I will present about qualitative characteristic of the conceptual framework for the financial reporting. There is two main components of qualitative characteristic, which is fundamental and also enhancing. For the first qualitative characteristic, fundamental, was a bare minimum for financial info to be worth looking at. Means if there is no fundamental aspect in that financial report or info, the report or info will be useless. For the first fundamental aspect, faithful, require company to make a report or info that was complete, neutral, and error-free, that show actual economic reality. Means there is no bias or whatsoever. The second fundamental aspect is relevant. Relevant require company to make a report that useful for decision making that can influence user. Means that the reporting or info was closely related with the company information. The second qualitative characteristic, enhancing, boosts the fullness of financial information after it already meets the core requirement. The first enhancing aspect is comparability. Info can be compared across time. For example, the current financial position can be compared with 2 years ago financial position. The second enhancing aspect is verifiability. Knowledgeable user can confirm the accuracy of that information in financial reporting. The third enhancing aspect is timeliness. Info available in time to influence decision. And the last enhancing aspect is understandability. The info present clearly for easy understanding.
Assalamualaikum, my name is Shafiq. I will present about elements of financial statement. Elements of financial statement, number one is asset. So assets can be defined as resources business own or control that have potential to produce economic benefits. Example of asset is cash, equipment, and account receivable. Second element is liability. Liability represents debts and obligation as a result of past event. Example of liability is account payable and not payable, also loan. Third, we have equity. So equity can be defined as the residual interest in assets of the end entity. Equity also can be defined as ownership claim in total assets. So example of equity is capital and reserve. In equity also have two more elements that's called income and expense. So income can be defined as increase in assets and decrease in liability. Example of income is sales revenue and rental income. Second, we have expense. Expense can be defined as increase in liability and decrease on asset. Example of expense is salary expense, utility expense, and others.
So I will be talking about underlying assumptions, recognition, and measurement in accounting. These concepts are important because they help us prepare financial statements that are clear, reliable, and useful. Let me begin with the underlying assumptions. These are basic ideas that guide how accountants record and report financial information. The first assumption is the accrual basis. Under the accrual basis, a company records revenue when it is earned and records expense when they are incurred. This happens even if no cash has been received or paid yet. This assumption gives us a more accurate picture of a company's performance because it matches income and expense to the right time period. The second assumption is the going concern assumption. This means we prepare financial statements with the belief that the company will continue operating for the foreseeable future. In other words, we assume the business will not close down soon. Because of this assumption, companies can record long-term assets, use depreciation, and follow normal accounting rules. The third assumption is called periodicity. Periodicity means dividing the life of a business into artificial time periods such as months, quarters, or years. This allows the company to report financial results regularly instead of waiting until the business ends. It helps users compare performance over different periods. The fourth assumption is the economic entity assumption. This assumption states that business activities must be kept separate from the personal activities of the owners. This prevents confusion and ensures that financial statements show only the business financial performance. Now let me move on to recognition. Recognition is the process of deciding when and which items should be recorded in the financial statements. For example, when should revenue be recognized? When should expenses be recorded? Recognition makes sure that financial information is relevant, reliable, and recorded at the right time. Finally, we have measurement. Measurement is about deciding the amount that will be reported for each item. It answers questions like, how do we measure a liability? The goal of measurement is to ensure that value reported reflects the true economic reality of the item. In conclusion, the underlying assumptions together with recognition and measurement provide the foundation for accurate and meaningful financial statements. They help users such as managers, investors, and creditors make better decisions.